Well, welcome everyone. We are the panel on the session on ETFs 2.0. We have an excellent group today, and I'm really excited to be here. We have 4 papers, and so as a result, it's going to be pretty tight. The paper presenters are going to take around 15 minutes. The discussants around 10. That leaves us maybe 5. I hope I can get questions in if they're there. If you in the audience have questions, please put them in the Q&A and we'll try and get to them when we have time. So I don't want to take any more time away from our speakers. Our first paper is Fixed Income ETFs, Bond Liquidity and Stress Markets, and Thomas Marta from Wilfrid Laurier University will be presenting. So let me turn that over to our speaker. Thomas, do you want to share screen? Excellent.
Perfect.
The floor is yours.
Thank you very much. It's a great honor to be here. Thank you very much for having me, especially with you, Maureen, as the chair of the session. So this work is entitled Fixed Income ETF, Bond Liquidity and Stressed Market. Since I'm the first paper on this session on ETF, I thought I would start with this chart showing the growth of ETF and the assets in exchange traded fund in over the last 2 decades. You can see they reach now nearly $9 trillion US, and you can really see the speed of the growth in the last 10 years, where it was barely above 1 trillion in 2010, and now it's over 10 trillion US, which is more than the hedge fund industry or the private equity industry. So there is a very high ETF growth. And if you have a look at the literature, the theoretical literature, it suggests an ambiguous effect on the effect of the basket or the ETF on the components. And what I study in this paper is corporate bond ETF or corporate bond ETF, meaning ETF that tracks bond indices. And what's very interesting about those ETF is that the gap between the liquidity of the ETF are traded on the stock market, as we know. The largest corporate bond ETF trades $1 billion of trading volume per day. The quoted beta spread is 1 basis point, and everybody can see the price and trade. Meanwhile, if you have a look at the bonds, we know that they trade over the counter. You need to request dealer for quotes, which are indicatives. And you've shown, Maureen, as a paper showing that electronic trading has been growing on the bond side, but it's still quite marginal. And so a natural research question is, what are the effects of those liquid corporate bond ETF on an arguably fragile or illiquid bond market, and what is the impact on the liquidity of the bonds? And a second question is, do the same effect dominate during periods of market stress? Because there's a suspicion that arbitrage will make ETF problematic during periods of market stress. So what I do in this paper, I use a recent quasi-natural experiment to address 2 known issues that are problematic with that research question, that are the self-selection. ETF are known to self-select liquid securities. And the other bias are the index effect. Since ETF replicate indices, it's hard to disentangle the effect of the ETF from the effect of an index. And I pay close attention to market stress event and arbitrage following suggestion of theoretical papers. And what I find in this paper is that corporate bond ETF seem to increase their bond liquidity, and the results are quite robust to market stress events and arbitrage. So in the interest of time, I'll be quick on that very large theoretical literature on the effect of a basket on its component. The effects are ambiguous depending on the model setting. Turning to the empirical literature on specifically on ETF, most of the literature so far as focused on equity ETF with ambiguous result, a detrimental effect on the volatility of their stock. If you have a look at Ben David and co-authored GF paper, turning to corporate bond ETF, Kathleen Danozer, who agreed to be my discussant next, really put corporate bond ETF on the radar for us and has shown that corporate bond ETF increase the price of the bond. And there is 2 contemporaneous papers with a similar research question on the effect on bond liquidity differ from them with my quasi-natural experiment and novel data, which, as I've shown from the first chart, since with the growth of ETF, it's quite important to have novel data because the market has radically changed in the last 10 years. I relate also to the large literature on corporate bond and the corporate bond liquidity that has followed the creation of Trace. So I use Trace, which is a data set that provides us with corporate bond transaction. I start with a large sample from April 2010 to March 2020. I also use CRISP to obtain the holdings of the ETF. And so that one thing that I do is I use multiple proxies of corporate bond transaction cost from that large literature using Trace. Some of the proxies are a measure of transaction costs that are really adapted to Trace and that control for all the treasury moves that could impact the bonds, such as delta Q from Bessembinder, Maxwell, and Venkataram. Some measure capture the fact that the bonds do not trade every day, and that's a 0 measure. And the idea is if a bond is expensive to trade, it will not trade every day. A measure of implicit cost. There's a round-trip cost measure, and some measure are more inspired by the equity literature and work, are more noisy to use in this setup. And my other key variable is the ETF ownership, which measure the percentage of the bonds that are held in a corporate bond ETF. And I use all the investment grade and corporate bond ETF that I find on CRISP. So I'll start classically with panel regression. I regress the bond I, month M measure of transaction costs. You have all my, in the column, you have all my measures of transaction cost. And I regress it on the ETF ownership lagged. I have a bond fixed effect control for the bond heterogeneity, month fixed effect to control for the time trend, and multiple proxies that varies at the bond and month level. And what I find a positive relationship between bond ETF ownership and bond liquidity, meaning that the transaction costs are smaller. That's why you see it negative when a bond is held by an ETF. So this is the panel over 10 years, and those results are quite robust. It varies a bit with the variable, the proxies of transaction costs that are more linked to that are more inspired by the equity literature, but the results are quite robust to periods of market stress, such as what happened in March 2020, but also the taper tantrum, the debt ceiling crisis. They are quite robust to primary market activity, arbitrage, risky bond, non-risky bond, liquid versus illiquid bond, different way to filter trace. But it's with panel regression, there's only so far you can go, and you cannot really make a causal statement due to the possible self-selection issue of ETF self-selecting liquid securities. So to address this bias, I use quasi-natural experiment, and the first one is using the fact that Bloomberg, the Bloomberg indices change the minimum size to be part of an index. And so at the beginning of my experiment, all my bonds are already self-selected, if you want. They're already in ETF and in ETF. And what happens is, due to the change in the rule, the minimum size to be part of the ETF, some bonds leave the ETF. So that is to bonds with a size between 250 and $299 million. Those bonds have to leave the ETF, and I compare them with similar bonds just above the threshold that stay. And so all the bonds are already self-selected, and some bonds leave due to the change in the minimum size to be part of the Bloomberg index. And as a result, what I find is post-treatment, the bonds that leave, the transaction costs tend to increase, implying that when you leave an ETF, you become less liquid. So that's my difference and differences. I have a placebo test validating the parallel trade assumption, and the results are quite robust except for two measure roll and zero. I also have an additional test when I have a look at what happened during ETF sell-off using that quasi-natural experiment, and I confirm that the finding that bond that exit ETF tend to experience a liquidity deterioration. But there's still a potential bias that it may be due to an index effect and not an ETF effect. And in order to address this second potential bias, I turn to another quasi-natural experiment. This time, it's a very large ETF, the second largest investment grade ETF, that switches from tracking one index to another. So indices in this setup, they do not change, just the ETF switches from tracking one to tracking the other. And what I do here, I define my treatment bonds are bonds that join the ETF because they are in the second index and not in the first index. And my control bonds are bonds whose ETF ownership stays stable. So they stay in ETF, and there are similar bonds. I select them using propensity score matching. And then I compare what happened 6 months before, 6 months after the change in a difference in differences setup. And so here I can study the effect of joining before I study the effect of leaving an ETF. This time, when you join an ETF, your transaction costs tend to decrease for most of my measure, not all, but most of the proxies of transaction cost, meaning that, and again, I have a placebo test to validate the parallel trade assumption. So the way I interpret those results is when you join the ETF, bonds seems to have a liquidity improvement, and that validates my the previous test while addressing the indexed effects, because the indices do not change in this experiment. Only an ETF changes from tracking one index to tracking another. And in additional tests, I show that the results are robust to arbitrage on the ETF and to the absence of arbitrage on the ETF. I move to the daily frequency to do those tests, and I lose some power, but I have some interesting result there. Finally, I wanted to, following the theoretical literature, I wanted to point out to a possible transmission mechanism. And I found that I can relate the panel result to the growth of the ETF trading volume. It doesn't work for all the variable. The high and low and IQR from inspired by the equity literature do not work, but for the more robust measure inspired by Trace, they do seem to hold. And it seems that the more a bond belongs to an ETF that has a large trading volume and that trades more and more, the more liquid will that bond be. And the way I interpret this result is similar to what happened when Trace was released, and suddenly there was post-trade transparency when market participants can know where the bonds are because they can see the trade. The previous trades, then they stop overpaying for bonds because they know the real price of the bond where they should trade. And I argue that with ETF, corporate bond ETF, suddenly market participants know where the bonds are and they can trade the ETF thanks to the ETF trading volume. And that transparency has the same effect that what was found 10 years ago with the introduction of Trace. it has the effect of reducing the transaction cost. So in conclusion, what I do in the study, I use recent quasi-natural experiment that specifically address the issues of self-selection and index effect. I use multiple measures of transaction cost based on actual bond transaction. And I find that there seems to be a positive causal relationship between corporate bond ETF and the liquidity of their bonds, even during periods of market stress, even when there is arbitrage. And I highlight a possible transmission mechanism with the ETF trading volume. Thank you very much for your attention. I look forward to Kathleen discussion and your question.
Thank you, Thomas. You're right on time. So good for you. Our discussant is Caitlin Danhauser. So let's see here. Caitlin, I see you're ready to go, I think, right?
I think
Excellent.
so. Can you hear me?
Yep, you're good.
Awesome. Thank you. Thank you, Maureen, for having me. Greetings from COVID isolation. I unexpectedly am not here, so I apologize if they're not where I was expecting to present. I apologize if there's any technical issues. I wanted to start off by first just congratulating Thomas on a thorough paper. For those of you that haven't had an opportunity to dig into it, there is a 40-page appendix with 25 extra tables. So it's obviously something that has a significant amount of work, and I purposely avoided getting into liquidity in my job market paper. So I am impressed that he did. So the boss, Maureen, said, don't summarize. So I'm taking her orders and jumping right into it. Even if you just look at this paper's title, Fixed Income ETFs, Bond Market Liquidity, Stress Periods, three very important things. So you're not going to find any issues from me if this is an important topic. And it's also rooted in theory, as regardless of what you find, there is a theory that supports your findings. To date, as Thomas mentioned, there are conflicting findings in both the corporate bond empirics and the equity empirics related to how ETFs impact their underlying. My evaluation study, which is my job market paper in the JSE, in table 10, I looked at 4 different proxies of ETF liquidity or activity, tons of different transaction costs. And at one point, I remember writing uncertain to potentially negative. Apparently, when I reopened the paper with one eye, which is how most people feel about their job market paper after a while, I changed that to insignificant to negative. I wish I would have kept that uncertain part. Since then, as you can see, there's been a bunch of follow-on studies that continue to find conflicting results depending on where you look. One that I'd like to highlight is by Holden and Nam. The part I'd like to highlight here is that they say that perhaps these conflicting findings can be just due to differences in the bonds. In particular, they focus on the prior access of uninformed investors. This is something I would like to push Thomas to consider, because I think that, and as I'll get into, it's going to be hard to get a definitive statement, but if we can look at which bonds are affected differently, it could be really important. His contributions are listed here, and I'm going to talk about all 4 of them in my points. So jumping into my comments, my first is related to the strength of the claims versus the results. Anyone involved in the ETF literature, I'm sure Bloomberg or BlackRock calls you to talk about your results. And my fear here is that if we're going to have something that says ETFs have positive effects on liquidity, which essentially is right there in the abstract, we better make sure that that's the true statement. Part of this is beyond Thomas's issue. This is the fact that measuring liquidity in bonds is really hard to do. He mentioned in his discussion that he uses a bunch of different proxies, and I agree with him. I'm going to focus on IQR, and obviously this is nitpicking as that's the one that flipped around, but Hellwig et al. Said that this is the measure that's less sensitive to outliers. And this is important because according to the write-up in the tables, Windsorization only occurs in tables 5 and 7. And so when we look at that, I can't necessarily definitively say, hey, there is, without a doubt, a positive relationship between ETF ownership and liquidity. So in fact, in the appendix, IQR is positive and significant for high yield. So I have a few suggestions here for Thomas to consider, but I would just say, in order to make these statements, we better make sure that they're robust to all different types of settings. The second one is the claim that this positive association continues to exist during periods of stress. I list the periods of stress here, and in particular, I have April 2020 in red. I think April should be excluded. A paper that we're going to see coming up talks a lot about the Fed's activities. And then it was March 23rd that the secondary market purchases were announced, in which corporate bonds would be included. So I think that April potentially is an issue there. Here, I would say I'm not necessarily, again, convinced that this is exactly saying that there's a positive association. It's not negative, I will give you that, but it's not necessarily positive, especially with bid-ask hanging on to significance by the skin of its teeth. Here, I have an issue in the fact that it's a subsample. So we're going to pick endogeneity that the most liquid bonds are trading in these periods. It's just what happens. Bond shops tend to just shut down in these periods. My other concern is the use of bond and date fixed effects here. So here we're looking at within bond changes. So suppose that we get rid of April 2020, a bond's introduced or is issued in February 2018. So it's only going to show up in your sample in February 2020 and March 2020. If ownership decreased because of redemptions, an alternative read of the coefficient is that because this variation is leading to an increase in illiquidity. And so therefore, I think we have to be really careful and dig into the details here. And so some alternative fixed effects would be helpful. At a minimum, I would suggest the use of interactions and really encourage you to disentangle this opportunity between arbitrage when transmission is happening, particularly in my RFS paper tantrum paper that looks at the 2013 event. There we saw transmission. In March, a lot of the ETFs were just allowed to trade at significant discounts, and so that transmission wasn't occurring. Part C of this point is related to arbitrage neither impacting positively or negatively. My big issue here is how you define arbitrage in just that it's the month-based, because first, your redemptions would have most likely high overlap with those stress periods. I would like more information about that. Also, we're not even sure that arbitrage can actually occur because of representative sampling. Some of these bonds might just have no change in ownership. And I think that's an important thing to think about disentangling. In fact, in March of 2020, I was digging into the data, and despite these bonds trading at significant, or ETFs trading at significant discounts, some bonds actually experience creation. And so although it's endogenous to be included in the basket, I think that that's one way in which we do have to look at this. My next point is I really think that his natural experiments are super interesting. They're new, and that's a good thing. And I love that they're a part of the modern period. I want to know if it's a permanent effect or if it's just something like an immediacy effect from Dick Nielsen and Rossi. When I think about assumptions, I first think you should be grateful that this is not a staggered diff and diff, given what's going on in the econometric literature there. But when we think about those assumptions, we have to assume the comparability of our treatment and control. You need to include age in your propensity score match to start, and you need to present statistical significance between the difference of the control and treatment groups, beyond just the summary statistics in the appendix. For quasi-natural experiment 1, it seems that the treatment are more liquid and held by fewer ETFs. And you also have some bonds that have time to maturity less than 1. Throughout, you should eliminate that. And when you do other potential matching, we have signs that flip, which is concerning. For quasi-natural experiment 2, here, those bonds, the decision of the sponsor remains endogenous. So if, for as far as I can tell, your control group are bonds that are eligible, but don't actually end up in the ETF. Here's a suggestion for an alternative control group. My big thing here is with diff and diff, it brings back a picture is worth 1,000 words. And when I was working on my job market paper, I was like, hey, I'll do this for liquidity. And it was a disaster. So it brings back bad memories, but I am encouraged to see you do this. But I want to see more pictures for both quasi-natural experiments and for more measures, because here I'm not convinced that the parallel trend assumption is met. In fact, it seems like there's something going on in those 3 months leading up to treatment. My other thing is, throughout we're saying liquidity is good, or ETFs are good for liquidity. So I would have assumed that given this figure and the fact that controls have lower transaction costs, they would have higher ETF ownership, but they don't. And so I'm confused at why ETF ownership is not beneficial in this pre-period, but only in the post-period. The big things that I really would like you to focus on is the mechanism and the modernization. I think the modernization is really important. I feel so old and that my paper ended in 2014. In 2020, the world has changed, and I think you should look into this. You do have to address the simultaneous events, such as Maureen's electronic evolution paper. The trading volume, I think, is really encouraging. And I have a reason why. I want you to take a look at your measure, though, because I'm a little bit concerned if I interpret it properly, that I think that you might have more liquid bonds or bonds exposed to greater liquidity actually having lower measures. I think you really should dig into those potential explanations that you have, but it may be beyond this paper. And part of this is because a paper that hopefully I'll post on SSRN soon, we find a decoupling of ownership and liquidity. And anecdotally, you can just see it right here. Of the top 3 corporate investment grade ETFs, what you can see is that LQD accounts for 74% of the average daily trading volume, but only 30% of the assets. So it's not even that ownership and liquidity are the same thing. So in conclusion, this is a really important paper, and I'm probably being harder just because of that, because of its relevance to so many market participants. The evidence, I would say, I said I used to think it was uncertain to potentially negative. Now I'm leaning to uncertain to potentially positive. I'm not certain that you'll ever be able to definitively say that, but it feels like if you can just kill me with 1 million paper cuts, then I'm gonna have to take away this uncertain and potentially positive. Good luck with everything, and look forward to talking to you more, and congratulations.
Caitlin, thank you very much for that. Thomas, would you like to respond very quickly?
Oh, I want to thank Caitlin, because in addition to her discussion, she sent me a full referee report, and that is going to be extremely useful. I'll just say that I have a point of divergence with some liquidity transaction cost measure inspired by the equity literature, because they don't control for underlying moves in the treasuries, which create large move intraday, such as the interquartile range, IQR, for example. So I prefer some other measure, but I keep using those for transparency. But all the comments are well taken, and I'll work on them. Thank you very much.
Excellent. Well, I think we're going to move to our second paper. Our second paper is 2 APs are better than 1, ETF mispricing and primary market participation. It'll be presented for us by Taisha Sikorskaya from the London Business School.
Great, thank you very much. Hello, everyone. I hope you can see the slides and hear me well. Can you hear me well?
Yes, you're great. Looks good.
Great. Thank you very much. Thank you. All right. I would like to first thank the organizers for the opportunity to present in this session. Evgenia and I are very, very excited to get feedback. This paper is indeed about exchange traded funds, or ETFs, and in particular, it is about the structure of the primary markets, that is the markets where ETF shares are issued. As Thomas already showed, the ETF markets have significantly grown in size, and ETFs are becoming an important investment vehicle for both institutional and retail investors. ETF shares are traded on exchanges, and similar to closed-end funds, ETF share price might deviate from the value of fund holdings. So to limit such mispricing, ETFs introduce special markets called primary markets, where supply of ETF shares is adjusted. In these markets, only registered brokers can operate. These brokers are called authorized participants, or APs, and understanding what guides the behavior or activity of APs is important because they have a right but not an obligation to create or redeem ETF shares. Primary markets are a unique feature of ETFs compared to other investment funds. So these markets have already attracted significant attention from those who research the financial stability and asset pricing implications of ETFs. But due to the lack of appropriate data, the actual structure and granular activity of these markets have not been studied, and most academic papers assumed a representative AP. The plot on this slide suggests that this assumption might not be innocuous. We sort domestic US equity ETFs into terciles on the number of APs that were active in them in 2019. Funds in the first tercile, in light blue here, seem to experience larger daily deviations in share price from their net asset values, especially during the COVID turmoil in March. In this project, we aim to understand the differences in primary markets across equity ETFs and explain how and when these differences contribute to mispricing in ETF shares. We first collect novel regulatory filings and document several stylized facts about ETF primary markets. We find that funds have a different number of broker connections and different concentration of their primary market volumes. We also describe brokers who operate in ETF primary markets. Most of APs are prime brokers, so their reported volumes, in fact, include activity of their clients. The level of mispricing, to a certain extent, is a measure of how well primary markets function. So in the second part of the paper, we study how primary market features are related to mispricing in the cross-section of ETFs. We find first that US equity ETFs with more diverse AP networks experience significantly lower mispricing on days with high financial market stress. Second, the sensitivity of flows to mispricing is higher for funds with larger networks. And third, we find stronger co-movement and mispricing of funds that have more APs in common. Our leading explanation of these findings is that APs are heterogeneous in terms of their balance sheet usage costs, and that these costs are passed through to ETF mispricing. For funds with smaller networks, mispricing is more sensitive to shocks to such costs. We present two indirect tests consistent with this explanation, and we find little support for other channels such as access to ETF investor capital, NAV calculation disagreement, or arbitrageur inattention. And finally, we illustrate this explanation in a model in which more diverse networks help mitigate the effect of shocks to AP-specific arbitrage costs. I will not have time to describe this model during the talk, so please see the paper. All right, let me start by recapping what ETF mispricing is and why APs play a special role in eliminating it. Typically, ETF share price and the net asset value of fund holdings move together, as we show on this slide. However, a demand shock can push prices away, and this relative distance between the ETF share price and the NAV is called mispricing. An arbitrageur can sell shares and buy the basket of underlying securities to capture this spread. If prices converge, arbitrageur can realize profits by closing both positions, buying the fund and selling the basket. However, there is always a risk of divergence, as shown on this slide, in which case arbitrageur incurs a loss. In contrast, authorized participants are special because they have a right to convert the basket to ETF shares and back at a fixed NAV price. And because of this, such a trade is a textbook arbitrage trade for APs or their clients. So it is natural that they are important for keeping the ETF prices close to NAVs. Even though many papers have studied ETF mispricing, there used to be no data on the actual participants in primary markets and their disaggregated activity. And this is the data that we exploit in this project. We collect so-called end-to-end forms from EDGAR in which ETFs have to report all their APs and their respective trading volumes. Since these forms are new, we only have data for 2019 and 2020. We also link this data to the AP entities from FactSet, but otherwise our data sources are quite standard. In the first part of the paper, we simply describe ETF primary markets. We observe connections between ETFs and APs that are plotted in this picture. The blue nodes here are APs and black ones are ETF families. Some of them are clearly more connected than the other. And importantly, we call it a registered connection when ETF and AP have a legal agreement, but we observe trading volume. So we can also see that some of these registered connections are not active. That is, AP never creates or redeems shares. And the network of such active connections is actually less dense. We also describe authorized participants. These 15 IPs on the slide brought about 98% of the primary market volume in 2019. About 50% of the volume comes from the top 3 APs, and the APs seem to differ a lot in how many funds they're actually active. So overall, it suggests considerable concentration. However, for institutional reasons, most APs in the US are also prime brokers. They offer institutional brokerage services. So the reported trading volume actually represents a larger number of traders. It is important to keep in mind that APs themselves may not be the end arbitrageurs in those cases. There are only a few brokers in our sample, such as Citadel, whose volumes of trading come directly from APs themselves. To study differences in primary markets across ETFs, we construct the following fund level features. The first one is fund connectedness, which is simply the log number of registered APs. Second one is primary market activity, or log number of APs with non-zero trading volume. Then the primary market diversity, 1 minus HHI of AP trading shares in the fund. And finally, as I said, reported volumes of some APs represent a larger group of traders. So to assess the importance of APs who do not bear this additional intermediation costs, we also compute the share of direct primary market volume. On the right, you can see the sample medians for 2019. Most domestic equity ETFs have 32 registered APs, but only 7 of them ever trade throughout the year. Trading activity seems concentrated with 69% median diversity, and 18% of primary market volume comes from non-prime broker APs. We next link these features to mispricing in ETF shares. We start by running the simplest possible cross-sectional regression for all equity ETFs in 2019, whereby we regress the average fund mispricing on each network feature. Here we control for a number of fund characteristics that may be related to both mispricing and the quality of the network, as well as several primary market characteristics. We also include investment category fixed effects. We find that ETFs with larger and more diverse primary markets experience less mispricing on average, and funds with more direct primary market volume also have lower mispricing. Using specification with all controls, as one standard deviation improvement in the network feature is associated with around 15% less mispricing in fund shares. A potential problem with this test is indeed reverse causality. So in the paper, we first confirm that past mispricing is not a significant predictor of future AP registrations or activity. And to further mitigate such concerns, we fixed the network features as seen in 2019 and studied daily mispricing in 2020. We assume that market dislocations during the first months of COVID were largely unexpected, so relating mispricing in 2020 to the network in the previous year should partially address this reverse causality issue. We control for the same static fund characteristics, but also daily fund liquidity, turnover, benchmark return. We also include investment category and day fixed effects. But most importantly here, we introduce interactions with negative and positive FSI dummies that gauge the level of financial market stress. We find that in good times, after taking into account all controls and interactions, there is little to no relationship between primary market features and ETF mispricing, as shown here in the first row. However, on days with high financial market stress, having a larger and more diverse primary market is associated with lower mispricing. These findings are robust to using VIX instead of FSI, alternative definitions of mispricing, and also holding subsamples by fund size. Next, we study sensitivity of ETF flows to premium. This sensitivity was suggested by the literature as a measure of arbitrage efficacy. The higher the sensitivity, the more responsive the primary market to arbitrage opportunities. We find that quite intuitively, this sensitivity is higher for funds that have more APs. And finally, we study whether AP identities matter for ETF mispricing. To do so, we regress correlation and daily mispricing between any two ETFs in our sample on the number of common APs. And we find that this beta here is strongly positive. So mispricing moves more for ETFs that share more APs. And again, this effect is concentrated in high stress times. We also see that the correlation is not sensitive to the number of common APs in pairs, where both funds have more than a median number of APs shown in column 4. So these results taken together suggest a role for AP heterogeneity, and large networks seem to mitigate dependence on a particular AP. To explain our findings, it is probably convenient to think in terms of a break-even condition on arbitrage trades. It is profitable for arbitrageur to trade via API if expected gains exceed primary market transaction fees, ETF level costs such as short selling costs, and costs specific to this API. We have a more formal link between arbitrageur cost and equilibrium mispricing in the model. We do not observe this highlighted IP-specific costs in the data. So next, we perform several indirect tests to understand the nature of these costs. And I'm going to show that it is the AP balance sheet usage costs that are a likely driver of these AP-specific costs in our data. In the first test, we exploit that many prime broker APs helped the Federal Reserve in its bond ETF purchasing program in 2020. Some of APs had a larger exposure to the program, that is, they had to trade significantly more than usual to accommodate the Fed's demand. If AP's balance sheet is costly, we would expect higher mispricing following shocks to capital commitment. In other words, more exposed AP is likely to increase its prime brokerage costs or decrease balance sheet space provided to its clients. So we measure AP exposure by dividing the total Fed purchases of ETFs through this AP by the AP's total bond ETF volume in 2019 appropriately scaled. And we find that equity ETFs, whose most active APs were more exposed to the program, experienced significantly higher mispricing during the implementation of the program. Importantly, the effect was 4 times larger and statistically strong for funds with smaller net worths. This suggests a spillover to equity ETFs through their APs, which should only happen if the balance sheet of exposed APs is costly. And second, we study fund mispricing during the regulatory short selling holds of ETF shares when arbitrage is only feasible with inventories. If there are no inventory constraints, this relationship between network features and mispricing should be the same as on other high stress days. To test this, in our 2020 daily panel, we had an interaction term with ETF-specific hold dummy. We find that primary market network is even more important for mispricing during such holds, which indirectly suggests binding inventory constraints. And finally, we explore several alternative explanations in the paper, but find little support for channels other than regulatory costs. All right, I will conclude now. In this project, we offer a granular description of the US ETF primary markets and show that ETFs with larger and more diverse AP networks experience lower mispricing in times of stress. We argue that there is a pass-through of AP-specific balance sheet costs to ETF mispricing, and the larger and more diverse primary market helps mitigate shocks to this cost. We hope that our research can inform the regulatory debate on stability of ETF markets and help in further studies of asset pricing implications of ETFs. Thank you very much for your attention, and I look forward to Yao's discussion.
Thank you, Taisha. Our discussant is Yao Zhang of the Wharton School.
All right, can you see my screen?
Yep, you're good.
All right, thank you, Maureen, for inviting me to discuss this super interesting paper. I really enjoyed reading it. All right, I think this is a super innovative paper about a first order important context, the primary market of ETFs. And there are a lot of things to be liked. And authors use new regulatory data, the annual NSEM forms, which allow them to identify exactly who are those APs. And this is obviously a big step in the literature. And they provide new facts about the structure of ETF private market, who matches with who, and then they explore the consequences on ETF mispricing. Again, so this is all important context, rich data, interesting analysis, and want to expectfully and say congratulations to the student authors. And maybe one of you is gonna bring this to the job market paper, to your job market at some point. So, and I would like to definitely see this at some point. And with that in mind, I'm gonna share some of my thoughts potentially to help you tighten the economic message here and to realize the full potential of this paper. All right, my first comment / question is to ask whether this is the paper about networks or it's about the number of APs. And the reason I had this question is because the paper has a title of 2 APs are better than 1, and the model reflects this too, because only the number of APs matters there. But when you write the paper, you heavily rely on the notion of networks. But this is something I'm not quite sure, because when I look at the 4 main network features, I'm not exactly sure they are really about the structure of the network. For example, for the first 3, connectedness, that's essentially the number of registered APs. PM activity, that's the number of active APs. PM diversity, that's 1 minus HHI. Well, in other words, even without knowing the network of the structure, right, the structure of the network, you can pretty much construct those proxies by knowing the number and the volume of those AP trading. And then talking about the 4th one, the share of direct PM volume, you actually define that by aggregating all the APs. So in other words, even if you don't know the number of APs, you can construct that proxy. So to be clear, I'm not saying that there's any issue with that, right? But I think the question I would like to ask is, does the network pitch really help with your economics, or it's just the buzzword? So I think there are 2 potentials here. One is to perhaps tune down the network language a little bit, but focus more on a more comprehensive set of AP features, such as number of APs, which you already have, and the size of APs, the leverage of APs, etc. I think to think about the trade-off between those dimensions would be super interesting, because that would allow you to ask questions like, are 2 small APs better than 1? Large APs, or are 2 high-level APs better than 1 low-level APs, and etc. I think those questions could be interesting because it really allows you to pinpoint the economic mechanism at play, right? Really, it's about the size of the balance sheet, or it's about leverage constraint, or it's about diversification. Or there's another direction in which you keep your current network pitch, but you dive deeper into real network features to really think about, on top of the number of APs, how the structure really matters. You can ask questions like, are 2 periphery APs better than 1 core AP, or is a star network structure better than chain structure? Again, it's just examples, but I think the key point here is, if there's anything on top of number of APs matters, right? That should be reflected in the structure here. That should be reflected in the relationship among those APs. And I would like to see a clarification here, whether it's that structure which really matters. Okay, and this is related to my second comment / question. Is the paper about the consequences of AP participation on ETF mispricings as you currently pitch, or it's more about the matching between APs and ETFs? And the reason I'm thinking about this direction is because when I look at your main regressions, especially table 4, in which you regress cross-sectional ETF pricing on those 4 AP features, before controlling for fund characteristics, you see those 4 features are quite different, right? So, I mean, it's very intuitive, because those 4 are about different economic mechanisms, and you have R-square, which varies across those 4 specifications. But after controlling for fund features, you see, number 1, a much higher R-square, but most importantly, the R-square barely moves. And that means that the cross-sectional mispricing are mostly driven by fund features, but not AP features. Or in other words, if you first control for fund features, and then you add those AP features and report incremental R-square, I would suppose the incremental R-square might be pretty small. And there's a similar issue here when you run daily, when you regress daily mispricings on those AP features, because again, when you look at time series mispricings, they're mostly captured by your time fixed effects, but not AP features here. Again, I'm not saying there's anything wrong here, so they are perfectly sensible regressions, but I'm just saying the takeaway here is probably not really about participation of APs on mispricing. It's more suggestive of a matching pattern here. Certain ETFs are matched with certain APs. And this is actually related to a fundamental data challenge here if you want to push for treatment interpretation, because you only have an AP features at annual level. And then when you run panel regression at the daily level, that's essentially a cross-section regression. But then the cross-section level AP features are heavily driven by fund features. So I'm not saying there's any easy solution to that, but there could be something you can try. For example, instead of running those 4 different regressions on separate AP features, you may try run a kitchen sink regressions, putting all the AP features together and try to figure out which AP features matters more than others. That could perhaps give you an explanation of which one matters more economically. And then you can take a step further. You may try to find if there's any plausible exogenous shock to ETF primary market. Again, I think it's hard. I'm going to give you some examples later, but that could potentially allow you to better address the causality issue if this is just a selection point here. And there's a middle ground here, which is perhaps we can design more targeted tests to flesh out the economic mechanism of why 2 is greater than 1 and what and under what conditions. One thing we can try is you can also take a step back. Instead of pushing for the treatment interpretation, you can just say, we're going to study the matching between ETFs and APs, i.e. net information, which I think is actually quite interesting. And especially given that there's another snapshot of data coming in soon, then you're going to have 3 snapshots that could potentially give you a better chance addressing the question of net information. I'm going to talk about my third point, which is related to the comment I made earlier, and potentially flesh out the economic mechanism better. And this is related to some results you just mentioned, table 7, 8, 9. They're super interesting to me because they really speak to the economic mechanisms at play. But right now, I feel that they seem a little bit isolated from each other because they do not seem to give the same conclusion regarding whether 2 is greater than 1. And each exercise seems to point to some different economic mechanism. For example, table 7, you show that more APs, they imply larger common shock in the sense that when an ETF has more APs, this ETF is more likely to have overlapped APs with other ETFs, and that's going to generate more co-movement in the mispricings. So that implies that maybe 1 is greater than 2 because that's going to make you less vulnerable to such common shocks. Versus table 8 is about more APs unconditionally help ease short sale constraints. Versus table 9, it's really about a market segmentation hypothesis in the sense that when you have an AP, but this AP is too busy trading bonds, and that AP may actually hurt you. So taking all of those things together, I think they're super interesting. But the question here is, how can we potentially reconcile those two? How can we think about the net effect here? And how can we potentially identify a unified economic mechanism at play? So my suggestion here is, instead of doing everything, why not take a step back and develop a coherent mechanism / story and perhaps drive home the message by designing more comprehensive tests centered on that single economic mechanism. For example, if in the end you decide to focus on short selling constraint, which I think is economically important. And then what I would like to say here is to look at more actual shorting and short selling activities such as shorting fees or lending activities of ETFs in normal times, rather than just focusing on those short selling hot dummies, because they may just pick up high market volatility. And this same idea applies to your other channels as well. And one thing I would like to mention is to focus on one economic mechanism may also help you to identify your unique contribution related to the literature. Here I want to mention a complementary paper by Dorowaska, who is a job candidate from Wharton this year. who uses the same data to study similar questions. She focused on a different angle, talking about the trade-off between number of APs and the creation unit size. And for that reason, she uses ETF splits as a plausible exogenous shock to create unit size. Obviously, I think you have a different focus here, and you actually have richer analysis. So I really encourage you to think about this, how you can potentially pin down the unique economic mechanism better. All right, let me summarize. I think this super interesting paper, potentially important paper on the private market of ETFs. I would like to push also a little bit in the front of sharpen the economic message, and I will leave the choice to the author's creative license and look forward to reading the next version. Thank you.
Well, thank you. I think that was, again, another excellent discussion and right on time. Taisha, would you like to respond at all to these comments?
Yes, sure, would be great. Thank you. Thank you, Yar, so much for putting the time into the discussion. I absolutely agree on the first point regarding the use of network language. We have started the paper with that focus, but moved away due to data limitations, and we will be more careful in future versions on that. Regarding the second comment, with more and more data coming, researchers definitely need to understand better how connections are established. But for now, we only have one test in the paper, where at the connection level, we explore what fund and network characteristics drive future AP registrations and activity. Most importantly, mispricing is not an important characteristic there. And in contrast, past AP activity and an existing relationship with an ETF family seem to be important. But we had an eye on the network formation for a while, and we will see if we can strengthen the paper in this direction. And finally, I wanted to clarify on the interpretation of the test with correlations. We apologize that the version that Yao saw, in fact, did not have the result on correlation in subsamples, which perhaps makes the interpretation slightly clearer. In fact, given the fixed effects, this test shows that higher commonality in mispricing with the larger number of shared common APs, removing the effects of having more APs in the first place. And having a lot of APs in general reduces this sensitivity. So all our tests seem to work in the same direction. But what I definitely got from the discussion is that we need to describe our mechanism clearer in the paper, and we will definitely work on it. Thank you. If I have some time, I can also talk a little bit about the difference to the contemporaneous paper by Velina from Wharton. It is an interesting paper indeed, and we have several consistent findings, such as the concentration in MSN data and that the results are stronger for funds with smaller networks. An important difference is indeed in the mechanism that we're describing, but also in the assumption of her paper that APs themselves are end arbitrageurs. We think that it's quite a strong assumption, at least for equity ETFs, given the prevalence of prime brokers in the data. But we'll sure to keep an eye on the paper in the future. Thank you very much.
Well, thank you very much. And an excellent presentation by both the presenter and the discussant. And I want to congratulate our presenter. This is a tough meeting to come to when you're a student, and I'm very impressed. You got the paper on the program and did such a great job presenting it. So well done.
Thank you very much. Thank you.
Okay, let's move to our third paper, which is ETF arbitrage and international diversification. I think Ari is presenting this, but I'm not entirely sure. Am I right?
Correct. Yes.
Okay. Well, Ari, the floor is yours.
Thank you, Maureen. Thank you for organizers, including this paper in the session, and special thanks to Maureen for organizing such an interesting session. So the paper is called ETF Arbitrage and International Diversification. It's a joint work with Elias Philippou, a former colleague, and Harry Rosenthal, a former PhD student who works in the industry. So the motivation, the first bullet point is similar to what Thomas showed us. Basically, it comes directly from the fact that ETF industry has been growing rapidly, indeed very rapidly. Annual growth rate since 2012, so over the last 10 years. So basically the graph Thomas showed us is 22% for global ETFs for asset under management, and similar figures for US as well. What has not changed over time is the relative share of US markets, which we're going to focus in this paper, which is roughly 70%. So as of 2021, the industry, the global ETF industry is about 9.7 trillion, and about 6.8 trillion is from the US. Basically, it is so attractive because it's cheap to trade compared to active investment opportunities like mutual funds. So the transaction costs are relatively low. The passive versions of ETFs are relatively transparent because they have the portfolio composition files. You can see the exposures of the funds published publicly by the sponsors like iShares that we use in this paper. And there are also some tax benefits because you don't, as an investor, you don't directly hold the securities, but there's the ETF sponsor who is basically holding the basket. So previous research, including the first paper, also looked at the implications of ETF trading on underlying securities in the basket the ETFs are tracking. There are papers on informational efficiency, whether the price discovery happens in the underlying market or the ETF market, whether it has adverse effects on the liquidity of the underlying securities or on the volatility of the underlying securities, or co-movement of or correlation between the returns of the underlying securities. There are even papers on the implications of corporate governance of the underlying securities. Our paper will differ from that literature slightly. So our focus will be different. We will focus on country ETFs. So these are single country ETFs, which will give exposure to investors to invest in individual countries like MSCI, let's say Japan, Brazil, and so on and so forth. And we'll try to investigate the effect on international diversification. And this will be from the perspective of the US investor. So we are going to look at the correlations between markets, foreign markets, and the US markets. So here we know that the ETFs, that's one of the major selling points. If you go to the iShares websites, or there are websites that compare country ETFs, essentially tell you that will give you a cheap and easy access to foreign markets. So it is especially designed for retailers, but it's not limited. We know that institutions are also quite active in this market. So ETFs in general are designed for diversification because they track a portfolio, but country ETFs in particular, they are supposed to provide international diversification. What is the basic idea of international diversification? Ultimately, as a local investor, you can gain by investing in foreign countries because of the relatively low correlation of the assets within your current portfolio and the international portfolio. So that allows you to increase your investment opportunity set. Okay, so what are the objectives? First of all, we want to understand the exposure of country ETFs to global shocks. Here I put US/global risk. We are going to use mainly in the major part of the paper the VIX index and the shocks to VIX. Basically, this is the implied volatility on the S&P 500 as a proxy for global risk. But VIX has many features. It's a fear index. It's an economic uncertainty measure. So we are going to essentially start with VIX, but then deal with other robustness checks, decompose it, see whether it's a US shock or a global shock. So we want to first see whether how the ETF investors react to this VIX shocks when it comes to ETF trading. And we'll propose a mechanism. There will be an illustration, not a full-fledged model, of a risk propagation mechanism. Basically, these VIX shocks or global shocks, whether ETF markets facilitates the transmission of these shocks to local markets. And our identification strategy will be the staggered introduction of the country ETFs. So that will be at the shock level, whether the correlations between the market X and the US market increases because of the ETF trading through the arbitrage mechanism, which also Tasha described earlier on, basically, and later on, we are going to move to the cross-sectional differences, and we'll see whether there's a cumulative effect In other words, whether the cross-sectional differences and correlations with the US market can be explained by this ETF arbitrage mechanism. As I said earlier, we'll spend substantial time and effort on robustness checks, because you might argue that we have a limited number of countries, so it is evenly split in our sample. We have developed in emerging markets. VIX can capture basically changing economic uncertainty, but also risk aversion. So earlier Richard suggested the decomposition. We looked at that as well. Does it capture the global shocks, or is it US-specific shocks? Well, we orthogonalize the shocks. We also control for US macroeconomic news. If you're not happy with the VIX measure, essentially we also come up with a measure based on textual analysis from economic section of the Wall Street Journal. We searched the word uncertainty and use the word counts as a measure of uncertainty proxy. And for the introduction, staggered introduction, we do a placebo test, and finally some alternative specifications. Okay, so this is the mechanism we have in mind. Suppose that there is a positive shock in VIX, so that is basically a bad state of the world in the international macro literature. So this is a risk of periods. People would exit. We know that when there's an increase in VIX, people will leave the equity market, the US equity market. This is the US implied volatility. But at the same time, will it have any implication on the underlying market, foreign market? In this case, country A will have a cross-section of 41 countries in our sample. So given the shock, the VIX shocks, basically first, we'll argue, or we'll propose that if the investors in the ETF market are selling the country ETFs, the price of the ETF will go down below the net asset value. Here, the net asset value is basically the MSCI index, you can think of it, and that will create, if the price is below the NAV, basically that will create an ETF discount. And the arbitrage mechanism is such that the authorized participants, the dealers in this market, or brokers/dealers, they have to buy the shares, because basically they have to make sure that the lower form price holds. So they buy the ETF shares and short sell the underlying securities, and ultimately the net asset value should go up. Should go down, and this is ultimately the ETF shares will be redeemed, destroyed, for underlying stocks, so that they reduce the supply of ETF shares, and the authorized participants will close the position. So now the question is whether this type of event is basically, if the price discovery happens in the US market about something which is arguably is a global shock or a US shock, whether it will have any effect on the underlying MSCI index, on the underlying market. Okay, so if this shock is temporary or is not fundamental, as it's called in this literature, if it's just a noise, we should expect the NAV or the MSCI value not to change. But if it's a persistent shock and it's or a permanent shock or a fundamental shock, then we would see that the decrease in the S&P 500 will coincide with the decrease in the price of the, let's say, MSCI Japan or MSCI Brazil, right? So it's just a description, so the visual picture of what I was trying to explain before. Suppose that S&P 500 and the level of S&P 500 and the country I's ETF and now are in equilibrium. The level itself, actual level, doesn't matter here. We're going to focus on returns, right? So with the initial shock on VIX, so we'll have the S&P 500 going down. Initially, something that we need to check is whether the price of the ETF, of country ETF, will go down as a response to this shock, right? Then the arbitrage mechanism is going to work, and basically the authorized participants will be active. They will bring the price up and the NAV down, but only if this is a fundamental shock. If this is a noise, basically we should go back to our initial position. All right, so that's the mechanism we have in mind. We focused on a homogeneous set of 41 country ETFs offered by the sponsor iShares. So basically BlackRock is a subsidiary of BlackRock. There are other country ETFs, but we wanted to keep it the sort of similar set of assets. And we use the trade TAC data essentially in order to come up with this order flow or order imbalance from the secondary market. Taisha discussed the differences between primary and secondary markets. Again, what the authorized participants do in the primary market, there is the ETF flow, which our discussant Sean has a paper on, has an impact on the returns. That's the primary market, which we're going to control for, but our focus will be on the secondary market order flow or order imbalances. All right, so this is the first step in our mechanism. We have to first check what happens to the order imbalances, which is basically net buys minus net sells divided by the total buys and sells in the ETF market, as a response to the VIX shock versus a local VIX shock. This is orthogonalized, so it's purely country specific. So by the way, there are implied volatility measures for other countries as well, roughly half of the sample. For the rest, we use the realized volatility and the shocks to it. So these are the changes that are VIX. And we control for primary market order flow, arguably a measure proxy for the mispricing or non-fundamental demand is so called in the Sean's paper. And also we control for feedback trading using the past ETF returns. So the first interesting observation is here basically that there is the shock, a positive shock in the local VIX will basically create a selling pressure in the ETF market, but only if we don't include the global VIX or the US VIX. Once we include the US VIX with the other controls, then we see that the significance of the local VIX disappears. In other words, the global VIX or US VIX dominates. Here we have other controls as well in the final column, which is controlling for foreign exchange returns, an indexing measure time series properties of the country indices changes over time, and a price discovery, which I'm going to talk later on. Does it have a bite for returns? Well, we do that in portfolio sort analysis using the past order flow information. Does it change the returns? Yes, it does have an effect on returns. You can create a long short portfolio, and it's conditional on the VIX states in the sense that it depends on the country's sensitivity to the VIX shocks. So if the country has a high sensitivity to VIX, global VIX, then we see basically that comes from that significance effect, but it doesn't depend on the primary market flow, non-fundamental demand. All right, so next we have to see whether in the data we see any effect on correlation. So delta rho here is basically the correlations between the country I and the US S&P 500, and these are the shocks from an AR1. And on the right-hand side, we have the same variables. As you can see, well, in the first column, you see that the shock to the local VIX increases the correlation. It might seem quite counterintuitive. Why would the correlation increase if it's an idiosyncratic shock? In fact, we look at different VIX states. So low VIX is a good state of the world. Basically, there's a lot of leverage, flows, and asset prices are inflated. So in that case, an idiosyncratic shock will reduce the correlations, but in high VIX states, essentially the correlations will increase. But again, if you control for global VIX, the US VIX, basically local VIX is not significant anymore. So what happens is when there's a global shock to VIX or economic uncertainty, the correlations will increase. What is the implication? Basically, correlations increase means that the international diversification you get from the ETFs is not there anymore. Well, it's a bit too extreme. It's not that it's reduced or limited, right? So the identification strategy here is basically staggered introduction of ETFs. We have a range of introduction at the country level. So there is a cluster at the beginning of around mid-90s, March 96. Developed markets had their ETFs, but then for emerging markets, it varies from 2000, 2010 up to 2015. And when we see that in the week, so we use weekly data, in the week of ETF introduction, correlations jump. And also when we have other controls that holds. And also we conduct some placebo tests where we show actually the shocks, the uncertainty shocks are increasing the correlations. When we look at around the window of ETF introduction, only in the post period, if you look at 1 year or 2 years later, the shocks are increasing correlation, but not before. Okay, so that is essentially our FSC analysis. In the final part, so I have basically 1 minute to go. Basically, we have the cross-sectional mechanism. So we look at the return difference, so correlation differences across countries along 2 dimensions, price discovery and limit to arbitrage. So earlier papers mentioned that. Basically, what we show that to link it to the mechanism we have in mind, if the price discovery is happening for those countries where the price discovery is happening in the US ETF market, we see a higher correlation, so limited international diversification, where we have an alternative measure of international diversification. And also we look at another hurdle to arbitrage is the illiquidity Amihut measure or liquidity mismatches we use. In both cases, we see that consistently that when there are limits to arbitrage, the correlations are lower in line with the mechanism we have. So finally, let me conclude that we show that essentially order imbalances, ETF order imbalances are more sensitive to the global shocks, global uncertainty rather than the local one. And these are propagated to local markets to the ETF arbitrage mechanism. We identified that in the time series with the introduction of ETFs and cross-sectionally using sorts based on price discovery and limits to arbitrage. I'm done.
Well, thank you, Ari. Right on time. Our discussant for this paper will be Sean Davies.
Can you all see my screen okay?
Yes.
All right. First and foremost, I want to thank Maureen for asking me to discuss this very interesting and very important paper. But I have a lot to say, so I'm just going to jump right in. ETFs have swallowed the stock market. That's true for both domestic-focused ETFs like SPY, which follows the S&P 500, as well as foreign ETFs like the German ETF EWG. They've swallowed the market. Some anecdotal facts to suggest this. There was a nice article back in the Wall Street Journal in 2019 that just looked at December of 2018. And what they showed is that 37% of all secondary market trade was the trade of ETF shares. Moreover, in the Investment Company Institute's 2021 fact book, they show that this is also true for the primary market. So if we look at 5% of trades in the market as a whole, they're facilitating something in the ETF primary market, the creation and redemption of shares. Moreover, this isn't just unique to US-centric ETFs. If you look at the New York Stock Exchange most traded ETFs on any given day, number 1 will always be SPY. But somewhere in that top 10, it might be number 4, it might be number 7, is EEM, which is iShares Emerging Markets ETF. So it's consistently in the top 10. So ETFs traded both domestically and abroad are huge in our markets. As such, as academics, understanding the implications of the ETFification of our stock market is really important. And so today, my discussion is twofold. For the audience, I want to position paper and its importance. And then for the authors, I want to challenge them more on the theoretical foundation of their paper. I think this paper could have a really big impact. It just needs some fine tuning. And sort of my big point through my discussion today then is going to be that this paper is super ambitious and important, but currently the identification is elusive. So just as some motivation, this might be your favorite television pundits or maybe your least favorite, depending on who you are. But back in March of 2017, Jim Cramer said on his show Mad Money, at the end of the day, I'm against ETFs because they often create enormous distortions that can obliterate even the best of stocks. And so that's sort of the motivation behind what the authors are doing in this paper. So the idea is that when fear hits the market, like we actually saw just this past week in the US stock market, when fear hits the market, the VIX spikes and investors sell their portfolios and they sell indiscriminately. Now, what's different nowadays is that investor portfolios don't just contain single name stocks. They're not just liquidating shares in Apple, they're also liquidating basket securities, which are ETFs. And so selling these ETFs indiscriminately is going to put downward price pressure on those assets in those baskets. Now, there's this famous quote by JFK, but it's actually not attributed to him, or it's not really from him, but it's a rising tide lifts all boats. And so the way to think about it in the context of this paper is a falling tide lowers all boats. And so recent papers like Zahi Ben David and Rahib Mazawi and Franzoni, as well as Sosi and Jida, they argue that this ETF primary market, the creation and redemption of ETF shares, it transmits volatility and correlations from the ETF market to the underlying assets. And so the natural question is, if US investors are liquidating their portfolios when they're scared, and now they also hold international ETFs, say for the DAX in Germany, what is that going to do to the underlying assets in those ETFs and then affect the markets in these foreign countries? Will it transmit US market volatility to foreign markets? Now, why does this matter? Well, let's go back and put on our MBA hats from our intro to finance class, and let's consider a two-country economy with expected net returns of RA and RB, and we'll just set them equal to each other. Moreover, we'll assume that the variance of these two market returns are also the same. But importantly, the correlation between these two markets is zero. So if we just form a 50-50 portfolio holding one country's market and then 50% in the other country's market, we get a nice Sharpe ratio that we can easily solve for. Now, suppose countries become integrated not through the real side of the economy, but countries become integrated through the transmission of country-specific shocks via the ETF arbitrage mechanism, and suddenly that correlation goes from zero to something positive. Well, we can then find what the Sharpe ratio is going to be, and we can see that naturally it falls. As such, the transmission of local shocks via the ETF arbitrage mechanism, it's going to deteriorate the benefits of international diversification. So this is an important paper. Now, what the paper shows, and this is for both the authors and the audience, is that country-specific ETF order imbalances. So this is secondary market trades. This is buys minus sells divided by total trades. And they use the usual methods to identify buys and sells from the literature. But they show that this order imbalance, it's negatively related to the US VIX, and it's also negatively related to the country-specific VIX. So it appears that investors do sell when they're scared, both about things in the United States, as well as things in those specific countries. They also show that the change in return correlation of the US market and that country market increases in response to the US VIX, but not to say the German DAX VIX equivalent. Okay, and so the way to think about this, if we think about a network, the US is sort of central and other countries are peripheral, which probably is not that surprising to those of us in this room today. They also show that the changes in return correlation of US market and country markets increase after the introduction of country-specific ETFs. And so the evidence is consistent with the transmission story, but identification is missing. And so now I want to speak to the authors for a little bit. A few words on identification. The introduction of these country-specific ETFs is a really nice test, but importantly, that introduction is not random. Folks at iShares are thinking about when to introduce that German ETF, and then they're going to do it when the market conditions are right or when investors demand it. And this is sort of distinct from other ETF studies like that of Ben David et al. That exploit exogenous changes in index membership as part of their identification strategy. Also, a few words on ETF flows. The tests use ETF flows to control for non-fundamental demand, motivated by a paper that I'm very aware of. And the reason they do that is that Brown et al. Shows that ETF flows measure net excess demand, non-fundamental demand. Now, importantly though, Brown et al. Goes a step further in their paper, and I want to make sure the authors are aware of this. Brown et al. Emphasizes that of course it is possible that the non-fundamental force is correlated with fundamental demand. For example, over or under reaction to fundamental news. As such, when the authors introduce ETF flows as a control for non-fundamental demand, since that might be correlated with fundamental news, they might inadvertently be absorbing country-specific information, for example, country-specific VIX. And so we need to be careful when we use that as a control and think about what it really represents. A few final words, just a few more things on ETF flows. The authors should be really careful. Their dependent variable is order imbalance, which is secondary market trade. but they use this dependent or independent variable of ETF flows, and they need to be very careful because those two things are highly correlated. So it's a little unclear what the residual variation there is really picking up on. Just a few more words on the mechanism. Section 2 in figure 1, and this was the figure in the presentation, it argues that non-fundamental shocks should not induce positive correlation returns. There's this idea that it must result in a negative return on the ETF if it was non-fundamental. This argument is that ETF flows give rise to return reversals. I would push them a little bit on that because Brown et al. 2021 shows it's unclear whether or not flows predict positive or negative returns, and that's in remark 7 of the paper. It really depends, the direction of that return predictability determines on which side of the basket security is more exposed to non-fundamental demand. If the ETF shares are more exposed, it should give rise to negative return predictability. But if the underlying assets, the NAV is more exposed, actually give rise to positive return predictability, which could be interpreted as a return continuation. And final thought, very important paper. It just needs some polish and it needs to be grounded a little bit more in theory, but I really look forward to the next version.
Thank you, Sean. I think, again, another excellent discussion. Would our author like to respond at all to any of these thoughts?
Sure. Yeah, I'd like to thank Sean for his thoughtful comments. Absolutely. I mean, just on the point of, yes, US being central, we have spent a lot of time on that in the sense that we want to distinguish whether it's a US specific shock or is it global shock. I think ultimately we reached the conclusion it's more like in line with what Helen Rain put forward in the sense that these are global financial cycles. So the global aspect is a bit relatively more important rather than the US specific shock. So I'm not sure whether it's the hegemonic argument. On the ETF flows, yes, I've read that sentence over and over again, what Sean showed in his paper, whether it's there are correlated, essentially, the fundamental and non-fundamental shocks. But ETF flows, I mean, when we control for it, we don't see any effect on the correlations ultimately, and also that's precisely why we show the results both with and without the controls and obtain the different results. Yes, yeah, thanks a lot. Yeah, absolutely, and the identification, yes, the endogeneity issue, potentially endogeneity issue. It is a weakness. We are trying to find a better identification. Yes.
Okay, well, thank you. We turn to our last paper. We've managed to stay on time, so I really want to thank all our discussants and presenters. So our last paper will be presented by Davidson Heath, the heterogeneous effects of passive investing on asset markets. So Davidson, the floor is going to be yours.
Thanks very much, Maureen. Everyone can see my slides and can hear me?
Yes.
People are nodding. Okay, great. Yeah, thanks very much to the organizers and Maureen, and thanks everyone for being here. This is joint work with Jonathan Brogard and Da Wang, who's a PhD student at Utah. I think he'll be on the market probably next year, and he's terrific. You should try to hire him. With that in mind, so I'm preaching to the choir here, right? I won't spend too much time on these slides because we all agree that the fundamental tectonic shift in asset markets in the last 20 years has been the rise of passive investing. It's now well over 50% of fund assets broadly construed. Here's a slide from the Financial Times. The y-axis is in trillions with a T, right? It's about half and half between ETFs and classical open-ended index funds. Okay, this has correctly and appropriately spawned a burgeoning literature on the theory side and the empirical side, trying to say what should the effects be potentially and what have the effects been so far. Okay, thanks to Overleaf, I was able to jump in and add Thomas's excellent paper on the empirical side as we were having the other, as in the middle of the session. So this is a living document and the literature is growing in real time. Okay. The fundamental point that we want to, that sort of started off this project is the modal choice in the theory studies is to say, here's some model of the economy or of asset markets. Here's an index. I'm going to drop in a passive fund that just replicates the index. And what are the effects? And the modal choice among empirical studies is you have some panel of underlying assets, stocks or bonds, and you have some research design where you try to get, exogenous variation, and then you look at the average effect, right? The single treatment effect, which is the LATE. And we're going to focus on the A, the average effect, part of that, right? So this paper is making a very simple point, which is that passive intermediaries do not, and more importantly, should not, simply replicate the index pro rata. And as a result, passive investing has heterogeneous treatment effects. And because the trade-offs here are common across all different funds, the effects are systematic and we think highly material. In the empirical work and also in the setup of the little model, we focus on ETFs because we have like daily data. It's very transparent, but we think that the message holds more broadly. Okay, so how do passive funds, if they don't replicate their index just one for one pro rata, how do they actually do it? Well, like I said, we have a simple model, toy model in the paper, and we came across this. This is not from our paper, this diagram. This is actually a diagram we clipped from a white paper on the website of a large ETF provider. And they simply say, look, I mean, it's really nice, right? It makes the case for us. It says, look, we sample the underlying index, we build the basket such that, if you add more assets, you incur more trading costs, but you lower your tracking error. And we come to some interior optimum. That's it, right? So we think they should do it. Our model says they do it. They say they do it. To what extent do they do it? Is it actually kind of material? Okay. So to get our arms around the sort of plausibility here and the magnitudes here, we do a case study of VTI. Okay. And again, after we chose VTI as our trial balloon, there was a big article in the Wall Street Journal came out talking about VTI, the mutual fund that ate Wall Street. It says, based on a little known index called CRISP. Okay. So VTI is the third largest, as of even date, the third largest ETF in the market. SPY and IVV are the two bigger ones. It has 300 billion in AUM, but the gravamen of the Wall Street Journal article is that that's just one of the share classes, right? One of the other main share classes is the classic open-ended fund, which is VTSAX, right? Which is kind of famous. And if you put those all together, that portfolio has 1.3 trillion in assets. Okay, tracking as best they can, the CRISP US Total Equity Market Index. And the first thing you observe when you look at the VTI basket on a day-to-day basis is that it contains like about 1,200 to 1,500 stocks. And you say, wait a sec, that's a lot less than 3,000 and change, which is what's in the index. So what does the weighting look like? What does inclusion, exclusion look like? Well, what we do here is for a given day, we simply sort all stocks in the CRISP valuated index, right, which is sort of the US universe of US stocks, on the basis of their lagged prior month effective spread. Okay, and the most liquid tercile of stocks are mostly all there in the basket, not all though. The middle tercile is a little less. The least liquid tercile of stocks is almost totally absent. Only 29 out of 1,200 stocks in that tercile are actually in VTI's basket. Okay. Now the model says, and we verify, that other characteristics should also drive this decision. So you want to see like a proper regression with like controls and clustered standard errors or whatever. That's what this is. And so you can see that the same principle, the same conclusion holds. Okay, so ETFs are strategically choosing to omit versus include assets. Liquidity seems to be like this extremely clear material determinant. So what? Why should we care? Okay, so research question 2, we want to use this mechanism that we're proposing and kind of go back and re-examine, okay, the classic question that the empirical literature has looked at: what effects do ETFs have on the underlying asset markets? Now, our key independent right-hand side variable is ETF primary flow, which is the daily net creation and redemption of shares of the ETF, okay? We don't use holdings or volume because we're looking on a daily basis. And I'll come back to say more on this in a minute, but ETF holdings, I mean, these are large passive entities that are tracking generally a market cap weighted index. So rebalancing kind of happens automatically. And so their holdings are very stable over time, modulo certain events that people use to get exogenous variation, right? Trading volume also, right? Bilateral trading volume is mostly going to capture just secondary market trades between two people. No direct link to the underlying asset markets. The problem, of course, is that ETF primary flow is endogenous, right? There's lots and lots of other things happening on any given day that co-determine ETF primary flow and market activity and quality. And so we instrument daily primary flow on each given ETF with that ETF's prior month return. Why? Robinhood. Well, you can think Robinhood, okay? Here's a profile of the 3 top Robinhood managers from the prior year. Timmy, 12, AUM of $250. This is what we all think of when we think of Robinhood, right? More systematically and seriously, Jeff Poniff and Caitlin have a very nice working paper titled Flow, where one of the observations they make is that compared to both actively managed and index classic open-ended mutual funds, if you look over to the right, relative to those guys with ETFs, the relationship of the prior month return with the monthly flow in and out is like enormously stronger. And they adduce some evidence that this seems to be driven by just like uninformed, retail traders return chasing, okay? And we find much the same thing. So column 1 here is the daily flow, primary flow in or out of ETF J on day T. We have a set of lagged daily returns to account for what happened in the market over the previous few days. And then the key one is the lagged return, the stale return from day 26 to day -5. Okay, and you can see that even though that return was posted and known 5 trading days before, which is an eternity in modern market time, right? It still has this very strong relationship with the flow. You can predict the ETF primary flow on that basis. And it's also very strongly correlating with the order flow imbalance for retail traders using Boehmer, Jones, Zhang, and Zhang, and with interest by Robinhood, with buying by Robinhood traders, which we get from the Robin Track website, the short-lived Robin Track website. Okay, so this is the first stage. We're going to construct a hatted value, a predicted value for each ETF's primary flow on that day, right? Based only on this like stale information that drives return chasing, okay? And then we're gonna, just see in the second stage, what effect does ETF primary flow instrumented in this way seem to have on underlying asset markets? And the re-examination here is really coming from these 3 liquidity terciles. You can see that in the most liquid tercile, across the top, right, there's these large, significant, and highly robust, I have to say, sort of treatment effects, okay? In the middle tercile, they're not so present and not so significant. And in the least liquid tercile of stocks, they're totally absent. In fact, the sign flips in 3 out of the 4 cases. And it's just, the treatment effect is just absent. Okay, so let's try to think, what does this mean, or how does this situate with the literature that so far, okay? We find that higher ETF primary flows raise intraday volatility and return correlations. That's exactly consistent with Zahi Ben-David's paper and Don and Shive's paper, of course, as Sean mentioned explicitly, okay? The other thing we find is that ETF primary flows on a daily basis consume liquidity and lead to lower price accuracy, lower price efficiency using the classic Hasbrook measure. A warning flag goes up and they say, well, Glaston, Nalreddy, and Zhu, which just came out in Management Science, find that higher ETF holdings lead to better price efficiency. And Sagalem, Tuzun, and Wormers, and Marta Thomas's paper find a positive effect of higher ETF holdings on better liquidity. So we just want to point out that this is there's no reason why ETF holdings, which again are extremely stable over time, modulo some treatment effect, should have the same effect as the daily ETF primary flows, right? And this is a figure from the paper where we show that on days when the ETF primary flow was higher, the trading volume in the underlying assets was actually lower during the day. But then at the end, it looks like the authorized participants are kind of delaying and pooling their order flow. They're balancing out the residual. I used to work in the industry. They're just trying to hit the VWAP, right? The volume weighted average price for the end of the day. And so it's very plausible that the day-to-day, rebalancing or index arb can have different effects from the long-run stable ETF holdings. So to wrap up, passive ETFs, and we think passive intermediaries in general, do not replicate their index pro rata. They trade off tracking error versus transaction costs. Because the fundamental trade-off and the fundamental approach here is the same across all funds, okay? We think that this can inform theoretical models because this is sort of like the basic IO or the basic technology of this titanic passive intermediary sector now. Okay, and does that affect the interpretations or the predictions of your model? Reasonable question. On the empirical side, we think this means that systematically and materially, the effects of passive investing on underlying asset markets are heterogeneous with respect to asset characteristics, including liquidity. And that's it. Thank you very much.
Well, thank you, Davidson. That was great. The discussant for the paper is Larry Glust. So Larry, we see your slides. I'm not actually seeing you, but that may just be my view here.
You're on mute too.
So Larry, you out there?
Okay, but now how?
There we go. Yep, Larry, sounds good.
Okay,
You might want to put it on slideshow.
got it.
There
Got
you
it.
go. Perfect.
Well, I was going to say, at my age, it's nice to be invited anywhere. So I guess I'm showing my technological.
Larry, you forget, you and I are not that different.
Right. Right. Okay. So consistent with Maureen's request that we not do an introduction, and I love that request because I think it's done too much. That motivation that nothing here is no ETF is based on the baskets are based on all the securities was a really good point to make. It's just interesting to note, I think, that BlackRock doesn't care directly what the transaction costs are. The APs do, certainly. And of course, BlackRock wants to, like the APs, be happy. And of course, this is a point that the paper made as well. It may be an interesting question to ask whether do all APs care in the same way? I think sort of in looking at the effect on effective spreads, maybe you're sort of thinking that APs might care about effective spreads. Well, it sort of depends on how the APs trade the securities, and I'll have something more to say about that later on. The instrumental variable is pretty clever. I didn't think it was particularly strong with an R squared of 3.5, but it is really interesting to note that the order of magnitude of the R squared was one order of magnitude higher for the Robinhood primary order flow. So it works certainly for that. I wondered about the construction of the IV. Why not just regress absolute primary order flow on absolute lagged ETF returns? Did that not work so well? Because that just seemed like a more natural way rather than constructing the IV from another regression. Now, I would have thought to construct the aggregate primary flow, one would used a weighted average, and I think I had sort of an early version of the paper, and so maybe it was just not clear that, and in fact, that in fact is what was done, in which case that's fine. It doesn't explain illiquid stock turnover. Now, this makes sense, of course, if there are only 29 in the VTI, the illiquid names. But many more could be in industry ETFs and actually trade in seemingly unrelated stocks that are in the basket could affect those that are not in the basket. And I'm sort of thinking of Charles Jones' analysis of SEC experiments. And so it strikes me as a really obvious thing to look at to see whether there's there are fewer effects on the illiquid securities. I will mention just one thing. Lack of a result is not necessarily a result, and so that you find no effect on the illiquid stocks. Maybe you just don't have significant enough power with the IB. So it's interesting to note that the OLS results that are included in the appendix, that obviously Davidson did not have time to talk about, show that the results for liquid and illiquid are about the same. These are just regular OLS results of the primary order flow. And so, I got to thinking like, well, okay, yeah, that's right. These things are going to affect the order flow and ETF turnover, stock turnover in ETF primary order flow, likewise. And so the results are the same, are not different, and so the what must be similar for liquid rather than illiquid, and that might be an interesting thing to look into. Quantitative results, now I think I probably just misread this. So one standard deviation increase in instrumented primary order flow increases effective spread by 180 basis points. No, that can't be right. Or is it 1.8 basis points? The definition was unclear. It's got to be 1.8 basis points. Effective spread for most liquid, it's got to be on the order of 1 to 7 basis points. But if it is 1 to 8 basis points, is this a big deal? I don't think so. But the paper doesn't claim it's a big deal either. The payment for order flow, the primary order flow has negative effect on price efficiency for liquid, but and actually I was just looking for a cite here that was not in the original paper. But what's interesting is we have kind of the opposite results in the sense that we did look at the issues for high cap versus low cap stocks, and the increase in the earnings response coefficient was for the low market cap, but not for the high market cap. So in some sense, it's sort of reverse things, which I thought was interesting. Now, we were not as careful about the identification as Davidson and his authors are. I will certainly freely admit that. I won't talk about the theoretical model assumptions. You can look at the slide. I think you got things left out. The increased effective spread I found really surprising. For one thing, finding market microstructure effects among the most liquid securities is really challenging, right? And to find it in the liquid and not the illiquid is weird. To find it, it's the coefficient is positive. You just say, well, what's going on here? And I'll be a little bit snotty here and say the reasoning of the paper was sort of like the coefficient is positive. So that means APs take liquidity, and hence the coefficient is positive. There was no real discussion of where this might come from. Now, here's my take on APs, and I never worked for an AP, and frankly, my friends at Virtu have never been willing to discuss what kind of trading strategies they might use, but I think they dislike crossing the spread. I think they probably would risk manage throughout the day to hedge the ETF position. And this is particular for the kinds of dislocations, primary order flows that you were looking at, which is mainly predictable from the previous returns. So it strikes me that if these APs are really active, they should be actively actually seeking to make liquidity, aggressively making liquidity, reducing the quoted bid-ask spread, and or increasing the size of the quotes. Both of these strike me as reasonable predictions. It's not real rigorous theory, but it's a little bit of hand-waving theory. Okay, but maybe not. I recently came upon a paper by a guy named Sita Lee, who's working with Bao at Shambana, and he shows actually APs are really kind of dumb in the way they handle the rebalancing of ETF portfolios. So maybe not, could be way around. Okay, but it strikes me that there might be some things to investigate. We're looking at effective spreads, and while midpoint executions are not a huge part of the data, they do significantly have an effect on effective spreads. So I don't know, given what's going on here, is there a reduction in the execution of midpoint peg orders? I don't know. I can't figure out why that might be. But it also suggests that you might look at quoted spreads along with effective spreads, because that will, if quoted spreads are going down, but effective spreads are going down, well, one explanation might have to do with the number of midpoint peg orders executed. Is the cost of making liquidity increasing? Maybe it is. Maybe it's not so costly for the APs to cross the spread. Maybe quoting is costly too. So you might look at realized spreads. Now, those get to be kind of noisy estimates, and so I can understand how you might not have a lot of power for that, but might be worth looking at. Okay, so my conclusion here, there's some intriguing facts here. I primarily focused on the information, that is the pricing error, and the effective spread. The others were somewhat less surprising in light of the previous literature. But I really would encourage folks to look at this paper. And I think the paper might be compelling for some theorists. And I will say that I don't think theorists have had a compelling empirical paper in market microstructure in a long time. I think these results need some explanation. So thank you.
Well, thank you, Larry. Another good discussion. That was great. Davidson, would you like to respond at all?
I'll say thank you very much, Larry. That was, as expected, a terrific discussion. So we just didn't think of trying the absolute on the absolute for the IV. So we will try that. Thank you. With regard to the finding of the null finding in the illiquid tersile, my view is that it's not a lack of power, simply because if you look at the, we can rule out statistically that there's anything happening that's anywhere near the same magnitude as in the most liquid tersile, right? And we show those tests, and the standard errors on the individual things are, they don't suggest low power problem to me. But that's a good thought. As far as trying to see if something is happening in certain sectors of the illiquids, I think that's 100% a great idea. And the idea of looking at industry ETFs, or even just looking at like small cap ETFs, right? And then looking at the universe of small within that tersile at the small caps, I think is terrific. And if anything, we would expect to find even bigger swings, because for those guys, the margins are just so wildly different, right? Or it's even more interesting. Let's see. As far as the magnitudes, we have to explain that better, and we will. As far as the explanation for the effects on liquidity and the quoted spreads, yeah, I think that's terrific. We need to do a lot better job on the microstructure side of the paper, and we will. But these are really terrific thoughts and suggestions, and thanks again.
Thanks, Davidson. You're too kind.
This is excellent. Well, we don't actually have any questions and answers in the queue, but that may just be because people were anxiously waiting for their chance to put one in. So let's give people, a minute, if you will. to see if there are any questions and answers that come in. While we're waiting, would any of the panelists like to ask a question of any of the other panelists? I actually had one as I was listening to Taisha's paper, which was, I love the network idea. I thought that was really clever, and I haven't, really seen anybody else do it. So I think that's kind of fun. But one of the things that I really thought would have been interesting would be to develop more do ETF fund families tend to have the same network of APs, right? I mean, I don't know the answer, but it certainly seems like they might. And if that's the case, you wonder if the fund family effect is important. And I think you looked at this, but I'm not sure. Any thoughts?
Yes, that's right. Thank you for bringing this up. Maybe I wasn't clear, but we did look at this. We noticed that basically the future registrations of APs are mainly predicted by whether they already have been connected with the family of this particular ETF. So that is a very strong regularity in the data. However, yes, for our results, we didn't see that it mattered that much because, or rather, it depends what you want to look at, because even within a family, typically there are ETFs with different levels of mispricing, very different characteristics, different asset classes. So at this point, we decided to stay at the fund level, but we can add more discussion on this to the paper.
It did seem interesting. I mean, I could well imagine that with, ETF issuance is, fairly concentrated. And, certainly within an ETF family, you have ETFs that have very different characteristics. But it would be curious if, for example, BlackRock ETFs in general have more APs than, the State Street ETFs, right? I think those sorts of things would be really interesting.
All right, thank you very much. Yeah, we noticed that for fixed income, in fact, family was even more important than for equity. So, but we will, I think it's a good idea to add this.
It'd be fun to look at.
Yeah. Oh, sorry. Good.
No, go ahead, Larry. Is it you?
Yep.
Excellent.
Okay. Yes. Taisha, that was a very interesting paper. I was embarrassed to find out that I did not know about the N-CENA CEN form. I started looking at ETF prospecti, I don't know, 5-10 years ago, and I looked really hard to find out who the APs were for each ETF I looked at. And I could find it nowhere. Now, somehow there's been an increase in the transparency, apparently, but apparently it's been not at the instigation of the ETFs, but at the SEC. Is that sort of where that came from?
Yes, that's right. I think it's a very recent initiative, and it was driven as part of the reforms that the SEC introduced in recent years, some modernization of disclosures. And these particular forms are only available for 2019 and 2020, and only for US, as far as I know. So in Europe, there is nothing similar.
I mean, so your results are really interesting because it had always struck me that this could be a competitive feature on the part of the ETFs, is saying, here are the APs we use, and this is how many we use. So I found your results very, very nice.
Okay, thank you very much. Thank you. There are a couple of industry practitioner papers out there that, for example, BlackRock, they report how many APs they have, but of course it is not a formal document, not a regulatory document. So we think that it's great that nowadays there are disclosures that allow academics to look into those markets. Yeah.
It may not help the regulation, but if it helps academics, we're all for it.
Yeah, a shout out to Ben David, Franzoni, and Masawi. I know that they were down fighting with the SEC to instigate to get that information revealed. So they were big into that.
Interesting.
Well, I think we are drawing to the close. I do want to let you know that we reached a high watermark of 102 people in this session, which I think speaks both to the quality of the papers that attracted all those people, to the discussants who everybody couldn't wait to hear, and also to the area, which continues to, I think, be an important one for us to address. So please, I want to take this moment to thank everyone and particularly the discussants who I think, as usual, gave very thoughtful and extremely helpful comments. It's hard to be a discussant, right? And being a good discussant is definitely something that helps our profession. So thank you very much. Thank you to the presenters. And I hope everybody enjoys all the rest of the remaining sessions in the meeting. Bye, everyone.
Thank you so much. Thank you. Bye-bye.
Thanks, Maureen.